Okay, so what I want to do in this video is briefly talk about stablecoin yield versus yield farming a base token. I want to also talk about the different borrowing platforms and lending platforms like Aave and Compound and Ethereum, for example. We'll quickly look at some DEXs and liquidity protocols like Uniswap and Curve. And what I want to do ultimately is help you to understand where Zeph is going to fit into the whole DeFi ecosystem and why it's going to pull in so much liquidity and end up causing the market cap of Zeph to explode from its current prices because of the unique way in which the source of APY for Zeph is different from the source of APY from current DeFi APY stablecoin protocols. So let's just jump right into it. ZephyrProtocol.com if you want to learn more. There's a lot of videos, there's blogs, there's a white paper. I suggest you look into it. Obviously, this is not financial advice. At any time, any of these crypto projects can go down in value for a variety of reasons, and you do your own diligence. This is just my theory, so let's jump right into it. Stablecoin yield is when you have an asset that's pegged to $1. For example, you have DAI, which is a stablecoin that's over collateralized by different cryptocurrencies, and they have a specific mechanism that will essentially sell that stablecoin as it gets close to 100%, and they'll be able to maintain their peg. DAI is one of our kind of competitors in terms of what's most similar to Zeph, but obviously Zeph has developed out some brand new innovative yield mechanisms that DAI does not have, and so we'll kind of look at some of those differences, but DAI is probably the most similar, so it's a good example. You also have USDC, which is a centralized stablecoin, so that's the other difference. DAI, D-A-I, is a decentralized stablecoin. It's basically created through an over-collateralized mechanism where anybody can just stake, let's say BTC or ETH, and then they can mint their own DAI. So it's decentralized with USDC and USDT. These are centralized stablecoins. They're issued by a central organization or company, and that company has the ability to freeze those stablecoins or has certain obligations because they are a company. And with Zephyr, of course, Zephyr is completely different, and it's a decentralized, over-collateralized stablecoin, which we talked about in my previous video. And also it says XPL here, which is actually incorrect. XPL is the new plasma, which I believe is the USDT, what do they call that? It's a layer 1. So ultimately, it helps for USDT to be transferred between different blockchains with no fees, and XPL is actually a base token, so that's a mistake. You can ignore that. In terms of the stablecoin yield, it has a source of APY, which comes mostly from lending interest. So what that means is if I have $1,000 worth of USDC, I can lend that to somebody and they'll pay 6% to Aave, and then Aave will pay me 5%, and ultimately by lending, I'll get 5%. We'll take a look at that in a little bit. Aave is really the biggest name in the game. You also have a lot of different other lending protocols. And then if you want more than 5%, then you can start to really get into like leverage and looping and protocol revenue, and that will really increase the APY. But the way that it increases the APY is uniquely different from how Zephyr has such a high APY, and that's really what this video is about. It's kind of like help you to see the whole landscape. How does APY on stablecoins even come about, and how is Zephyr different, and why is Zephyr going to actually go up in value because of this unique approach that it has to the source of yield. When it comes to protocol revenue, this can be borrowing and lending interest, like I said before, but it could also be trading and swap fees. It could be liquidation penalties. It could be stability and minting fees. It could be reserve or treasury investments. It could be a grant. It could be a variety of other different unique ways of trying to grow the APY, but a lot of these have risks, so you always have to be aware of that. So we'll take a look at Ethereum and Plasma and a few others today, and we'll talk about those different kind of aspects of each one of those. And then in terms of Zephyr, you have arbitrage, which I talked about in my previous video. You should watch that if you don't know what I mean. The reserve expansion. So because Zephyr is a proof of work blockchain, 5% of each block is allocated to the reserve. So a block is every 2 minutes. And the way that Zephyr works is that it will automatically convert 5% of the Zeph from the block into ZSD and then add that ZSD into the reserve. And that reserve is then split amongst all the shareholders. This is very similar to USDC lending pools, which we'll talk about in just a minute, but essentially the APY comes from the block emissions. It doesn't come from lending interest, and it doesn't come from protocol revenue, although in the future when it's on DeFi, it can also have those. So it's going to have something unique and different, but also be able to take on all the other components of DeFi, and that's really why it's going to suck in a lot of liquidity, is because it will have the best APY in all of DeFi, and I'm expecting this to actually kind of trickle and be slow at first, and then it will grow and grow, and then at some point there will be this moment where everybody kind of realizes that this is actually a really good APY stablecoin yield, and then it will grow really big very suddenly, and that's when you get the moment where the market cap will kind of 10 or 100x very, very quickly. And so the main point of this video is to highlight how Zephyr's source of yield is different from all other sources of yield in the DeFi ecosystem, and to help you to understand how it is different and why it's unique and why that's going to push the market cap up 10, 100, 1000x from where it currently is. And so, we'll get into all those details in just a minute. So in terms of stablecoin yield, the user experience is that you deposit $1, it stays $1, you earn yield on top of that. There's very little price volatility. Of course, with anything, there are risks. There's a peg risk. Can it hold the dollar peg? There are smart contract risks. There are third-party counterparty risks or other risks. And it feels like a crypto savings account. You have a stable principal that earns yield over time. In terms of yield farming a base token, you are essentially staking or lending a volatile asset that's not pegged to $1, such as ETH or Bitcoin or Solana or AVAX or any number of coins that goes up and down in value. And the source of the yield is liquidity provision, which basically just refers to swap fees or to other rewards from the DEXs or from your LP rewards. You can also get rewards from staking or validator rewards. There's incentives from new protocols. And if you have questions about this, you can dig into it. I don't want to get into too much detail, but essentially it's similar to stablecoin, but slightly different because it's more volatile. If I have ETH and USDC, I can pair them together into an LP and provide that to a pool, and then I get rewards for the swap fees, and I might get additional rewards from staking ETH or from different unique ways that they are able to kind of mine more money out of that. However, it's not usually a great investment because my experience is such that I could end up depositing 1 ETH, which could be worth $2,500. I might earn 5 to 20% APY, but ETH price could drop to 1,800, wiping out all of my gains. So there's a lot of risk here. I might have a huge APY. Let's say it's 1,000% APY on a token I've never heard of. And the reason it's so high is because either a lot of people haven't added their tokens to the pool yet, they haven't staked. So as more people jump into that pool, then I have to share the rewards with those people, so I get a smaller cut. Or it's because the rewards are paid out not in a stablecoin, but in a base token, which is then being sold to lock in gains, and in the act of selling, and everybody is selling, then the price of that base token is going lower and lower and lower as it's getting swapped out for a stable coin, and so then the APY is going down and down as a result because the value of the reward token is dropping and dropping. And actually that's kind of the case with XPL Plasma right now. The price is going down. I'm sure it will probably recover for various reasons, but one of the reasons that it's going down, among other reasons, is that you are getting paid your APY in wrapped XPL. So as soon as you're getting that reward, you might sell it. Some people won't, but a lot of people will, and that will push the price down. And then the APY in those pools will go lower and lower. So if you ever see a huge APY pool, you should be very skeptical. Maybe there are not a lot of people in the pool yet. You're very early, so maybe you could benefit from that. Or the payout is not in a stablecoin, and you should be very curious about whether or not that's the case. We'll look at some of that later today. There are, of course, risks because you have full market volatility. There are permanent loss risks. And, of course, same with stablecoins. You have third-party, counterparty, and other risks involved. It feels like a growth stock with dividends, but it's volatile. Price can swamp the yield. Okay, so really quickly, I want to talk about AUSDC, wrapped ZYS, and yZSD. So if you don't know what AUSDC is, it's basically a contract or a note that says you've lended USDC to Aave. So if I have 1,000 USDC and I want to earn 5%, I can lend it or stake it in that protocol pool, and they will give me in return AUSDC, which is a contract or a token that essentially says, hey, I do actually have a small slice of the pool, and so all the rewards that get added to that pool, I'm guaranteed a certain amount of those rewards. And so when I go to swap AUSDC back to USDC, I'll end up getting more USDC as a result. And my user experience is that my balance is static, but I redeem more USDC later because the pool adds up in value over time. It gets more USDC. And this is exactly what wrapped ZYS is. It's a non-rebasing type of token where the actual token itself doesn't increase. I always will have 1,000 of them, but when I go and swap back, I'll get 1,050, for example. Same with wrapped ZYS. It's a non-rebasing yield type token that when I go to swap it back, I will end up getting more wrapped ZYS as a result. So my balance is fixed. ZYS doesn't go up. The number of coins don't go up, but the value of that coin does go up. It grows. And when I go to redeem or swap, that's when I realize my gains. I get more ZSD. It's the same thing as USDC. If you have any questions about that, you should maybe YouTube this or ask below, and I'll try to answer to the best of my ability. Okay, so yZSD is a yielding Zephyr dollar. It's essentially a stable denominated income note where it's pegged to wrapped ZSD, and when you are holding your yZSD, it doesn't go up in the number of yZSD that you have. It's fixed. That's the same as wZYS and AUSDC. However, what's uniquely different about this is that once a week you'll actually get paid out in ZSD, and the experience feels like holding a share with dividends. So you have a principal stable and income arrives regularly. This is a dividend paying stable share. So instead of like your normal dividend stock, let's say you have Apple or Tesla or something that pays out dividends, the stock goes up and down in value, but you get paid dividends. In this case, it's a dividend yielding stable dollar, which is basically unheard of in the crypto industry. And this also, I think, is a really unique innovation that Zephyr is going to push out into the DeFi ecosystem that nobody is really ready for. Both wrapped ZYS and yZSD are extremely unique, and we're going to talk more about this in just a minute, but the only reason yZSD can exist is because of wrapped ZYS, and we'll talk about that. Okay, what I want to do in the next part of this video is just go through a few of the different apps or protocols that are available on DeFi so that you can understand what the DeFi ecosystem looks like, how the APY is being supplied, what is the source of APY, and why Zephyr Protocol is uniquely positioned to bring in a lot of liquidity from Ethereum and from other chains because of the source of APY for Zeph being uniquely different in such a way that is sustainable in terms of growth. So that will make more sense as we jump into it. Let's just get right into the first one, Aave. I think has the highest TVL, total volume locked, of any protocol. It is the OG, one of the first. It has the most trust. So remember, mercenary capital always goes to where they will make the most money. And that isn't necessarily to the most APY. There could be something with 1,000% APY, and you would not want to get into it because maybe the APY is paid out in a token that will go down in value, and so that APY will shrink fast, or the pool just hasn't been saturated yet, so when people jump into the pool, then you have to split the APY with everybody else, and so the value goes down. So a lot of capital is in Aave because it has a lot of trust. So one of these things that's very important is trust. Another thing that's very important is ease of access. Can you just click a few buttons and get into it? And really, when Zephyr is able to bridge over to Ethereum and go to all of the other chains, once it's on Ethereum, it will easily be able to go to Arbitrum and all of these other different chains. Then it could easily be accessible by everybody in DeFi. So ease of access will be achieved. Trust is what's going to need to be achieved. And that's why part of my hypothesis is that when Zeph goes over to Ethereum, it's going to be relatively slow trickle at first because there isn't going to be trust. But then when people realize, hey, this APY is good and it's sustainable, and it's unique and innovative in that it comes from proof of work and that it's a wrap token, and they have this unique thing called yZSD, which has an income payment once a week, then people will start to trust it more. When more people use it, then the market cap of Zeph will go higher, then the APY will go higher, or at least be sustained as more people enter the pool, and then trust will build and build, and there will be a moment where Zeph will 10 or 100x very quickly as everybody realizes this is $1 billion product. It's probably a 10, 50, $100 billion product. It will take time to mature into that, but that's what's going to happen. It's currently $7 million, so just picking up 1,000 might be a good idea. And it might be a good idea when you look at what the DeFi ecosystem is currently doing, because when you contrast that to what Zeph is doing, it's kind of a simple narrative. Zeph is providing more APY in a stable dollar that is better over collateralized. It's a privacy token when you move it into the native wallet. There's no slippage in the native wallet. There's very small fees. And the APY comes from proof of work. It doesn't come from lending and borrowing fees. It doesn't come from swap fees. It doesn't come from protocol rewards. It comes from proof of work, and also arbitrage and slippage. It increases the volatility of the asset. And when there's volatility, there's room for making money. So if there is a price difference in arbitrage, people can make money on that. And in the act of making money, they actually will end up pushing the market cap of Zeph higher. I talked about this at length in my previous video. If you have questions, you should definitely check out that video. But essentially, there are unique different ways that Zeph is providing a source of APY that is going to end up sucking in a lot of liquidity from Ethereum and from all of the chains. So let's take a look at the chains, and then it'll be a lot easier to understand. Okay, so if we look at USDC on Aave, we can see that you're getting 3.87% APY, and that there is currently 5 billion locked or so out of 7.5 billion potential locked. And if I want to borrow any of that, then I have to pay 5.61%. And so essentially, the reason I can lend this or stake it and get this percentage is because somebody else is willing to pay to borrow. And there's a lot of reasons why they would want to do that. But in this case, 3.87% isn't very much, so why would I want to do that when Zeph currently has 30% on a stablecoin, pays in stablecoin. Aave, of course, has trust and it has ease of access. but I would argue trust is the #1 reason. It's got the most volume and it has the longest history, so a lot of people trust it. Okay, so this is Fluid.io. This is another lending platform. In just one click, I can lend USDC. I actually have $10 being lent out. I've already made 0.001 USDC, and it's at 6.55%. But if you look at the details, you'll find out that it's actually 4.13% and 2.42% is in Fluid rewards, which is the Fluid token. And that token, of course, is likely going to go down in value because people are going to sell that for a stablecoin to lock in those gains. And the APY of 6.55% will end up going lower and lower and lower because the reward that is coming from that base token, Fluid, is going to go down in value. And also, the other reason why it will go down is because more and more people will enter the pool. And because there's more people, then I have to split the rewards with more people, and I'll get a smaller slice of that reward. So my APY will go lower. Everybody's APY will go lower. And that's why this is not very sustainable. Normally, APY goes down. It doesn't go up. With Zephyr, it actually goes up because Zephyr is proof of work. So when the market cap of Zephyr goes higher and higher, then the block emissions is worth more. So that 5% of that emissions goes into the wZYS pool. Then it has a higher value, and that's split amongst all the shareholders, and they get that APY or that yield, and that results in a higher APY because the market cap is going higher. If you want to be a part of that pool, you have to buy Zeph, which pushes the market cap higher, which then causes the APY to be higher, which allows for a sustainable amount of people to enter into that pool. And this is why Zephyr is unique compared to what you can find in DeFi at the moment. Okay, so this is allbridge.io. This is where you can bridge stablecoins between all possible bridges. And this is actually quite interesting. For example, USDC is getting 20% APR, at least in the last 7 days. That's what it got. The more people who add to this pool, the lower that will go. There's only $76,000 in it, so this is going to go a lot lower. For example, down here, there's almost $500,000 in this one, and it's only 8.64%. And the reason that this is higher than Aave, which is like 3.8%, is because you're actually getting protocol rewards. So remember, the sources of yield can be from lending and borrowing, can be from protocol rewards, and can be from additional strategies. In this case, it is a protocol reward in that when somebody wants to swap their USDT from Ethereum to Avalanche, they have to pay a fee. And that fee goes to the liquidity provider, and that's why they get 8%. It's just a calculation. So if I want to supply or lend my USDC to this platform, then I can get 8% in return. And the reason I get that 8% is because when other people swap in and out of USDC across different chains, then I get the fees. And there can be additional strategies that these protocols use. For example, they can take USDC and they can lend it out to somebody else. They can stake it somewhere else. They can get their own percentage of rewards and then take a cut of that and pay the rest out to the liquidity provider. So it's like I lend them a bunch of money, they take that money, then they use it as liquidity for bridges, and they take some of that liquidity and stake it and use other mechanisms, and then they get a bunch of fees and rewards, and then they pay that out to themselves and to the liquidity providers, and it ends up being 8% for me. I'll note that none of the reward comes from proof of work. All of this comes from strategies, protocol revenue, and lending and borrowing. And strategies refers to kind of like an umbrella term of a variety of different techniques where they can loop and leverage and use vaults and different techniques to increase the revenue from those assets. And this video is not really a good place to get into the details of that. I'm really just trying to outline how the source of yield on all of these DeFi platforms is uniquely different from the source of yield of Zephyr, and that Zephyr is actually not only competitive, but actually better in its yield source than all of these, and it can integrate into the DeFi ecosystem in a way where it can keep its unique source of yield while also taking on the current status quo of the DeFi ecosystem. What I mean by that is that wZYS can suddenly be also added to this pool, and then it can get additional APY through swap fees, or yZSD could be added and it could get additional swap fees. It could get protocol rewards. Everybody who has a protocol, Aave, Fluid, Allbridge, Athenify, Compound, Curve, you name it, any number of these DeFi protocols and platforms will want access to Zeph, to wZYS, and yZSD because they know that it has high APY. They will market Zeph to all of the DeFi community and say, ooh, look what we just got. This is a sustainable APY. You can stake it now. Go ahead and buy some and stake it on our platform. Why would they do that? Because they get a small cut of the percentage. They know that people want that high APY. They know that it's sustainable. And they will go ahead and develop out their protocols to include wrapped version of Zeph. And then that's when everybody will realize, oh, I should probably get some of this. So as soon as you see this on Aave, then it's game over. Zeph will already have 100x by that point. It's going to be on Fluid. It's going to be on Steam Protocol. It's going to be on Athenify. It's going to be on all of these platforms, and it's going to be performing way better than 20%. It's currently 30%. And it's not going to go down when people join the pool because it's a proof of work yield mechanism, so that when the market cap goes higher because everybody's wanting to get Zeph, remember the only way you can get in to the stablecoin yield, which is what this protocol is by getting Zeph. And if Zeph goes up in value, then the block emissions is going up, which means that the yield is going up because the block emissions is the source of the yield. And as that yield goes higher and higher, people will realize that they want to join and they'll buy more Zeph, and the yield will go higher and higher because the market cap will go higher. And then you'll get additional DeFi rewards on top of that, because then suddenly wZYS will be staked and added as liquidity. yZSD will also be staked. It will be added to all the protocols, and you're going to get this huge expansion of the Zephyr protocol, the Zephyr market cap. Everybody's going to want access to this. Okay, so I'm on the zephyrprotocol.com website. This is their blog. This came out September 25th. It describes all of the details of the cross-chain bridge, which is going to take the Zephyr protocol to Ethereum, and it's going to allow for all of the liquidity on Ethereum to move into the wrapped ZYS, which provides a stablecoin yield, which is competitive and better than all of the stablecoin yield that is currently available on Ethereum. So let's get into some of these details. We're not going to go through everything. We're just going to go through some of the main points. They are going to Ethereum. They eventually will go to other layer 2s. Once you're on Ethereum, it's a lot easier to bridge to all of the other chains. And the Zeph team is going to do this in different stages. First, they're going to do the stable dollar. Then they're going to do the non-rebasing wrapped ZYS. So again, we talked about this before. ZYS you don't get more of it. It just goes up in value because it's a pool that gets more water added to it from the proof of work block emissions. And it's just like AUSDC, which is what I get in return for adding USDC to Aave. I get a note that says I've added to the pool, and I'm guaranteed a certain percentage of the rewards that are added into the pool over time, so that when I swap back, I will get those rewards. And wZYS is the same thing. It's the wrapped version of ZYS, which is a pool that gets rewards from the block emissions. And if I own a part of that pool, then I'm guaranteed a specific percentage of those rewards, so that when I leave that pool, then I'm given that reward. And that's what non-rebasing means. It means that I have a token that is not going up in the number of tokens. It's just going up in value, because when I swap back, I'm getting more USD as a result of that. In this case, it's ZSD. Soon after, they're going to wrap Zeph and ZRS. Then in stage 2, they're going to create something called yZSD. This is a ZSD denominated income token paying wrapped ZSD. We've already talked about this. This is very innovative, and there's really kind of nothing like this in the DeFi ecosystem that I'm aware of. Essentially, from a psychological perspective, you are holding a stable dollar, and once a week you're paid in additional stable dollars to hold that stable coin. And the way that DeFi currently works is you normally have to kind of swap back. So if I have USDC and I add it to a pool, I get AUSDC in return, but my AUSDC doesn't go up in value. I don't see it until I swap back, then I see the value. And really, DAI from MakerDAO is really the best example, because if I stake my DAI into the DSR, then I will actually start getting more DAI into my wallet. And I think that's kind of the best parallel example to what yZSD is. And actually, DAI is decentralized as well. So again, it's a very good kind of comparison. But of course, the APY is like 5%. Versus Zeph, which is 30% now, and the market cap of Zeph is 7 million. If the market cap of Zeph goes to $1 billion, just imagine what the block rewards will be. Imagine what the APY will be. Imagine how many people could join the pool and actually reward themselves with that APY. As soon as Zeph goes to Ethereum, it's going to be game over. In my opinion, it won't happen immediately. I think that trust is a big part of DeFi, and as these different protocol platforms realize that they want wrapped ZYS and yZSD on their platform, they want to do all of their different strategies and protocol revenue and lending. They're going to start taking Zephyr in and then market it out to everybody. That's when people will realize, oh, wow, what's this new thing I can make a high APY on, and it's also sustainable. It looks like it's actually going up in APY as I add more and as people join the pool. Why is that? What is it? Oh, wow, this is proof of work? It's wrapped? How does that even work? I want more of this. As they buy more, they have to increase the market cap of Zeph, which will increase the block reward, which increases the ZYS, and you really get this kind of effect where it's very, very sustainable. And keep in mind, wrapped ZYS doesn't go down in value. So because of how slippage and liquidity works, there will be this arbitrage process, which will actually cause Zeph to go up in value as a result of that. I talked about that in the previous video. Having yZSD is a little bit different, because instead of having wZYS and seeing that stay static, it's non-rebasing. It doesn't go up in the number of coins. I might see that my value goes up, but I'm not getting anything in return. I have to wait, and then when I swap back, that's when I really reap the reward, or I lock in my rewards. With yZSD, I can hold it, and then once a week I just get paid ZSD. And so from a psychological perspective, yZSD makes a lot more sense. I'm really able to just essentially hold something and then get paid in a stable dollar and not have to swap anything in or out. And then I can just take those stable dollars and I can do whatever I want with them. I can even use yZSD as collateral, and you're going to see looping and leverage and all of these different other techniques with the yZSD. And actually, there's a question on Discord that's kind of asking about this, so I'm just going to jump to that really quickly and answer it. The question comes from this individual who wants some clarity from this statement. So what this individual is saying is that the 5% block reward is currently providing 30% APY. Right now, I can join the wZYS pool and I'll get 30% APY, and that all comes from the block emissions. Remember, 5% of Zeph is auto-converted into ZSD every 2 minutes, which is every block, and that's added to the pool. And if I own 10% of the pool, then I get 10% of that reward. So let's say that the price of Zeph was $10, and every block, let's say there were 10 Zeph per block. That would be $100 of value per block, because there's 10 Zeph per block, and they each are worth $10, so that's $100. And a block is every 2 minutes, so every 2 minutes, $100 is created. Now 5% of that goes to the wZYS shareholders. So 5% of 100 is $5. Now let's say I owned 50% of the pool because I want to do simple math and I'm doing this in real time. So $5 at 50% is $2.50. So if I owned half of the pool, which obviously that would be ridiculous, but if I did, I would have $2.50 every 2 minutes. And I would keep getting $2.50 every 2 minutes if the price stayed the same and if the block reward stayed the same. Now those two things are dynamic, so the price goes up and down, and the emissions of each block goes down over time smoothly. And then there's a tail emissions. So those things are dynamic. You have to keep them in mind, but they all get calculated out, and the number of people in the pool also gets calculated so that the actual APY ends up being a specific number. So currently it's around 30%, and that's what this individual is saying is if you add your ZSD to the pool and you get wZYS shares in return, just like if you add USDC to Aave and you get a USDC in return, you will get a guaranteed percentage of the reward when you swap back. And it's the same thing here. When you swap wZYS back to ZSD, you will get a specific amount of those rewards depending on the percentage of your share of the pool. So right now it's 30% APY. That's how it gets calculated out. Now, this individual is saying, well, you could get maybe 10% even on top of that if you take your wZYS and you add it into an LP or a liquidity provider position with ZSD. So this is where you have two tokens and then you add it to a pool. And the reason you would do that is because people might want to swap in and out of these two. And that's how pools work. It's not an order book where people place their orders. This is a DEX. It's decentralized. Nobody owns an order book. So you have a pool and you swap in and out. And in order to do that, you need liquidity providers, and they do that. Liquidity providers provide the liquidity because they get a reward or an APY or a fee in return. And that's what this individual is saying is you might get 10% as a reward for providing this liquidity. And that's actually a really good observation because you probably would get 10% or even more because wZYS is going to be so valuable. People are going to want to buy it and add it, and there's going to be a variety of protocol rewards and strategies in the background that are going to provide additional yield on top of the original 30%. Now he says, so at this rock bottom phase, you earn 40%, and if demand kicks in, we saw 200% APY plus yield could be 300%. I can't wait to push into liquidity pools. So what he's saying here is you have 40%. If suddenly on Aave you got 40% on a stablecoin or on AthenaFi or on Compound or Curve or any of these other platforms, you have a sustainable 40% APY on a stablecoin, then suddenly everybody wants it. In order to get it, Zeph has to go higher. If Zeph goes higher, the block emissions goes higher. If the block emissions goes higher, then the reward into the pool goes higher, which is what the APY is. And of course, if more people join the pool, then you have to divide your share amongst the reward. But if the reward is higher, then it equates out. And generally, we've seen that that's exactly what happens. The more people who join the pool, the reward is higher, such that the percentage is about equivalent, and it will probably even out somewhere. You know, the final point here is if it does hit, let's say 200% because the block emissions is so high, then you're going to also have pool yield. So that's what he's saying here. You can add it to a pool. You could also just single stake it. So you just add one token instead of pairing it with ZSD. You could just add wZYS to something and you could also get rewarded. There's a lot of techniques in the DeFi ecosystem that is generating yield through volatility, and then you'll essentially get more and more percentage, and he's saying he's very excited about that. Perhaps also there are risks for impermanent loss in these pools, and yeah, that's a very good point. wZYS is going to go higher. There isn't going to be a lot of interest in maybe providing wZYS, because wZYS is going to go up and up and up. And so if you provide wZYS in a pair with ZSD, there's something called impermanent loss. You will actually lose money, versus if you just held wZYS alone, then provide it into this pool. Yeah, you get some fees, but it won't make up for the amount of loss. And if you don't know what that is, you should just look at another video about impermanent loss. There's also another question on Discord, which I'm going to answer next. Okay, so Product Guy is asking a question which I think is a really good question, and it's probably going to come up a lot, and that's really what he's saying. Help us build a compelling case that can withstand unfriendly skeptics about the yield percentage. So really, one of the main reasons why I'm making these videos is because I'm so confident that if anybody comes out as a skeptic and says, oh, what about this? What about that? I'll be able to quickly say, oh, that's a great question. Let me tell you why that's not an issue at all. So one of those questions might be, let's see here. How is this safely different from what proved to be unsustainably high 20% Terra Luna? Okay, so this is a common question where people will say 30% APY in a stablecoin. Well, how is that sustainable? Well, the reason it's sustainable is because it's uniquely different in how the yield is generated. The source of yield is not like the source of yield from Terra Luna. That is a algorithmic stablecoin, where Zeph is a proof of work over collateralized DGED stablecoin, and that is the difference. So more specifically, in Terra Luna, in order to keep the peg, they had to mint more of the base token, which made the base token go down in value, and then they had this huge kind of a death spiral that took place. I don't want to go into details. You can look at it. If you look at other, high 20, 50, 100% APY, USDC, or even like yield farming tokens and stuff, the reason is there's not a lot of people in the pool yet, or the APY is paid out in a base token that's going to go down in value. Those are the two main reasons that they are not sustainable. So in terms of Zephyr, the payout is not in a base token, it's in a stablecoin. So that stablecoin can be swapped in and out for other stablecoins. It's not going to cause the price of Zeph to go down. So it's not going to cause the market cap to go down. And the pool is small in Zeph, but in order to get into that pool, you have to have Zeph to get into the pool. And that will cause the price of the market cap of Zeph to go higher, which will cause the proof of work block emissions to go up, which will cause the yield from the block emissions to be higher, which will sustain the number of people joining into that pool. So really, as people join the pool, they're actually pushing the APY higher in order to get into the pool, and it's very sustainable as a result of the way that people get into the pool. And of course, this is a very complicated process, especially when you wrap it, but I can tell you the wrap tokens are based on real native tokens, so it's not like you can suddenly just mint a bunch of tokens in the wrapped Ethereum version. If you want more real tokens, then you have to get them minted. And I went over this a little bit in my previous video, but in order for there to be more wrapped tokens on Ethereum, what will happen is people will have to go into the native wallet and mint them and then move them on to Ethereum. And what's going to actually cause that to happen is arbitrage. So as the price of ZYS goes higher, somebody who is interested in doing arbitrage will go into the native wallet at a discount, mint those coins, and move them onto Ethereum and sell them, lowering that price, making it closer to the native price. And by buying the native price, it actually will push that price higher. And then you'll get more liquidity onto Ethereum. And naturally, through arbitrage, there will just be this process of slowly trickling more native tokens onto Ethereum, and as Ethereum gets more and more tokens, then the value of Zephyr will go higher, and that market cap being higher will cause the emissions to be higher, which will cause the APY to be higher. And because of the way that ZYS works and that it can't go down in value because it's just a pool, if you look at how Aave works, the USDC pool doesn't go down in value. Of course, they don't talk about it like that because, you know, that's just not the way to think about it, but that's technically how it works. The USDC pool never goes down in value. It's just a pool. It's made of stablecoins, and people borrow from that pool, but they always have to give back the amount that they borrowed on top of 6% interest. So the pool just grows and grows and grows. That's the same thing as wZYS, except that it doesn't come from borrowing fees. It comes from the proof of work emissions. And if the blockchain is worth more, then the emissions is worth more, then the APY is worth more, like way more than what a borrower would pay. And then you really get this effect going and going. And, you know, that's really what I don't think anybody actually understands. Zeph is the most undervalued asymmetric investment that you could possibly buy, and you know at any time it could go to zero. I'll keep that in mind. I don't want to like have you sink $1 million into something like this, but I think just look what happens. Probably what I would recommend is as it gets onto Ethereum, it's going to trickle. Arbitrage is going to happen. You're going to see something take place. If it's working well, you're going to get this really fast feedback loop where it's going to grow and grow, and then everybody is going to start marketing it. All of these DeFi platforms will take it in and make yielding, like we talked about in the previous question, and then that yield will be marketed out and everybody will buy it, which will push the market cap even higher, and then you're going to get this huge ramp up, and you definitely want to get in before that. So if you're hesitant, wait and then kind of see how it responds, and then jump in right before everybody else realizes. As soon as you see like maybe one of the smaller DeFi platforms, like maybe Fluid, is newer and more unique, and maybe they would say, hey, let's take on a little risk, let's take in this token that we don't know much about, it's only 2 years old, and then they add that to their platform and they start marketing it. As soon as you see 1 or 2 reputable DeFi lending protocols say, hey, we have Zeph now, we have ZYS, that's when I would recommend any skeptics to start buying into this, because at that point the momentum is just going to take off. So let's jump into this next question here. It says, do we have or should we present a position paper or one pager? No, I don't think we do. I mean, well, there's no specific one pager. There is a lot of information on the website and videos actually that explain all of this in better detail than I ever could. So definitely check that out. But the dev did say, I saw recently, they're going to make like a one pager because this question is asked a lot. Again, just to clarify, it's sustainable because the source of yield is from proof of work block emissions. It is not from lending and borrowers. It is not from the protocol rewards. And, again, the rewards are from swap fees, from bridge fees, from arbitrage fees, from vault fees, from all these different strategies that they use, maybe from grants or from other money that they have. They're supplying you with a reward, and there's different techniques that they use, but none of them are proof of work block emissions. So it is sustainable because the way that the current DeFi ecosystem works is uniquely different in how they provide that reward. I'll tell you, in almost all of DeFi, the APY goes smaller and smaller over time. With Zeph, it will either go higher and higher, or, in my opinion, it will go higher and then be sustained at some point. Okay, says here, I know about 5% mining contribution, but haven't fully understood all the flows yet. We'll do more reading. Okay, I just told you a lot about that. I see that it's battle tested. So that, that's a really good example. So when people say, well, what if the peg is lost? Well, it went from $52 to 52 cents and never lost the peg. Why is that? Because DGED. What is DGED? Well, it's a very robust, very well-researched and real-world tested protocol that as the collateral that backs the dollar goes down, it will cause the reserve token to go down. And when the reserve token goes down in value, there's a lot of incentive to buy that token because it can swing up in value very quickly, even with small prices in Zeph. And so people will be interested in buying that. And if you buy it, you're basically buying Zeph off the market, which increases the Zeph market cap and helps to collateralize the stablecoin, and then you lock it into the reserve, which then backs the stablecoin even more. It's a whole mathematical model, and it was tested and created by Cardano and Emergo and Ergo, and so you can take a look at all of that really interesting information and the research paper that they wrote about that. But essentially, the protocol works, right? I mean, it went down 98%, never depegged. It's not going to depeg, as far as I'm concerned, because of the way that there is the moving average and the spot price, which kind of prevents people from manipulating the protocol, and it also causes kind of a slowness of the drift of people who sell and buy, and it really will slow down the whole process so that people who are interested in protecting the protocol will end up helping to support that protocol. Also, I will note, there's a lot of kind of details. I did actually talk a little bit about this in my previous video about the mechanism of DGED, so you can look at that. But you could always leave ZSD at any time. So if you're like, hey, the collateral is dropping, if you leave and if you swap out of ZSD, then the collateral goes back up because there's less ZSD that's needed to be backed. So then that also balances out. So that's really, there's all these different dynamic processes where as people leave and as people join, it balances itself out so that even if the price of Zeph goes up and down a lot, the collateral is always being backed in a good way. Okay, so I just want to go back. I clearly missed a few questions, probably the most important questions. How is this amazing ZYS yield possible? I already answered that one. It's through the block emissions. How is it sustainable? I already answered that. It's through the block emissions, and the only way to get into the pool is by buying more Zeph, which increases the block emissions. Does it eventually reduce gradually as ecosystem adoption occurs? The answer is probably no, because as people join the ecosystem, the market cap of Zeph goes higher. That's just really how it works. I can get into the details. I did talk a lot about this in my previous video, but basically, even if on Ethereum, through the wrapped versions, you're buying wrapped versions, through arbitrage, Zeph market cap is going to go higher because the arbitrageurs are going to go through the native process to move liquidity back onto Ethereum, and they'll make money doing that. They're essentially providing liquidity to Ethereum, they're making money on the side, they're increasing the market cap of Zeph, and people who are interested in this platform won't even have to touch the native protocol at all. They'll just stay in Ethereum and keep buying and buying, whereas arbitrageurs will go around helping balance out all of this process, which will add more liquidity to Ethereum, which will allow the market cap to go higher and higher, which will balance out this adoption, and the APY will get balanced out, and maybe the APY will go higher and higher. It's very difficult to model this out because there's several different dynamic moving parts. In my opinion, I feel like the APY is going to go higher from where it is now at 30%, and at some point it will stabilize at a higher point, and it will be the leader in stablecoin yield. Okay, so I just want to finish this video by going through the rest of this document and talking about the roadmap. So, yZSD, again, is going to be a unique way of holding a stable dollar and getting paid out every single week in more stable dollars, all powered by wZYS. And, they talk about this later in this article if you want to learn more about it. But basically, it's a ZSD denominated income token paying wrapped ZSD distributions on a cadence, default weekly. Holders mint or redeem 1 ZSD per token. So when you want to move back out of yZSD, you're going to get one of those stable dollars. The balances will stay constant while yield arrives as ZSD. So you just hold your yZSD, and then once a week you'll get more wrapped ZSD, and then internally the vault allocates the wrapped ZYS to capture appreciation that funds the payout. Okay, so why this matters. It's not a wrapped token. It's not a rebalancing form of ZYS. It really is just a ZSD income product that's powered by wrapped ZYS. Users think in dollar form. So again, from a psychological perspective, this is a lot more appealing. All I do is hold ZSD and I get more ZSD, and it mimics familiar experiences such as AUSDC. Technically, AUSDC is actually more similar to wrapped ZYS than it is to yZSD, because with AUSDC, you don't get paid out once a week or at any cadence. You just hold it and then you swap back and you get more, and that's the same thing with wrapped ZYS. And so with yZSD, it's actually quite unique, and there is almost nothing like this. Only DAI staked in their staking mechanism is the only similar type of protocol that I've been able to find, and its APY is like 5%. So this yZSD is going to probably end up minting around 30% or more, and you'll get paid out once a week. You won't have to swap back. You won't have to monitor anything. With wZYS, you have a share of the pool, and that goes up in value. But if you want to really kind of get the dollars from that, the ZSD, you have to swap back. With yZSD, you don't have to do anything. You'll just get ZSD in your wallet. I mean, when you really think about that, that's really impressive that the dev could think through this. If you're not buying Zeph now, what are you doing? This is like, I could see if you're not buying it because you don't trust it. That would be my number one reason. And you might not trust it because of its history. And that would be fine. Like, then don't buy it, right? But in my opinion, this is a trustworthy protocol. I put a lot of trust into this protocol. I recently bought $25,000 worth, and I'm allocating another $25,000 worth to this protocol. I think that it's going to go much, much higher. So I personally trust it. Obviously, this is not financial advice. You can do whatever you want. There are risks. You have to be aware of what those risks are. And we maybe I'll make another video about what those risks are, because it's important. But at this point in time, I really don't have any red flags. I couldn't be more bullish. I don't know why you're not. That's what this whole video is about. If you're not bullish on Zeph, just tell me below why, and I will do my best to provide all of the data and resources why I think you should be more bullish. So take a look at this article. There's a lot of information. Obviously, they go into great detail about how they're going to wrap it, the bridge UX, how they're doing all the different wrapping mechanisms, how they're going to provide a dashboard for the proof of reserves. They even went into detail about arbitrage, This blog came out after my arbitrage video, and they go into great detail about how arbitrage will essentially allow for stability of the wrapped tokens compared to the native tokens. And the devs are right on point here. They've given great examples with perfect math. I've double checked everything. The dev really knows what he's doing. He's done all of the work. He's prepared for what's ahead. And of course, arbitrage and bots are going to be a huge part of why Zeph is going to be successful. That's a huge part of my argument, is when the difference between the wrap version because of slippage compared to the native version takes place, arbitrage will be such that the native token will be minted and moved on to the Ethereum chain, which will provide more liquidity, which will balance everything out, which will drive the Zeph market cap higher, which will continue this entire heartbeat, which is Zeph. And if you believe in the future of over-collateralized, decentralized, private money, then Zephyr is the protocol that's calling for you. And like a well-hydrated goose once told me, Zeph is the dark horse coming to Ethereum, so you might want to get on this one. If you like this video, subscribe. Till the next one, see you then.